Hi, I'm Erik Ogard, CIO of the Wealth Plan Group. Today, I want to turn our attention toward fixed income. Now, fixed income has a long and illustrious history of being a very important part of investment portfolios. Primarily, it's because it provides income to investors who need income. And if you've been following Wealth Plan for any amount of time, you know that we spend our time thinking about what can we extract from the capital markets to meet the needs of our clients and to broadly the investment universe of investors. So we think of fixed income as vitally important. Now, in the last 10 years or so, until about 2 years ago, interest rates were at or near zero, which made fixed income a pretty challenging asset class. Hard to get the kind of returns investors wanted and needed, and hard to get the income investors wanted or needed. Then fast forward to 2022, when the Fed started raising rates to combat inflation, suddenly fixed income became interesting again. But it's not easy to be a fixed income investor. Rising rates pose challenges. Many investors were maybe caught flat-footed by what a rising rate environment means to fixed income portfolios. So think about the year 2022. In 2022, we had what we think of as the perfect storm. We had a sell-off in stocks and bonds at the same time. Now, historically, if you were an investor who had a balanced portfolio, the so-called 60-40 portfolio, 60% stocks, 40% bonds, you could count on that counter return balance you get from stocks and bonds, the yin and the yang, the ham and the eggs. And in 2022, we had a sell-off in both bonds and stocks, which meant portfolios that were balanced didn't enjoy the benefit of that diversification. That was very challenging for folks. And now we find ourselves in a situation where if you look at the long-term chart to the Bloomberg Aggregate Bond Index, you can see that it's been a really challenging period for folks, posing some problems. You need income, but bonds themselves have been losing value. So what a dear price to pay for that income. You know, not getting the benefit of diversification has just been salt in the wounds, so to speak. Now, do we think long-term we will enjoy those benefits of stocks and bonds being uncorrelated? Yes, likely so, but we're in a position right now where the nature of what we call the term structure of interest rates is inverted. So under normal conditions over long periods of time, the term structure is what we call normal or upward sloping. So if you think about what is the term structure, it's the yield of bonds over specific maturities. In a normal rate environment, you would have a 3-month bill yielding slightly less than the 6-month bill, which yields slightly less than the 1 year, which yields less than the 3 and the 5 and the 7 and the 10. So the longer an investor goes out onto the maturity curve, the higher the return they could expect in a normal environment. Well, now for 2 years, we've been inverted, meaning that when you go longer term in nature with your exposure, the yield is actually lower than the near term holdings. And so this inverted condition then makes being a bond investor really difficult. And to make matters worse, if you have longer term oriented bonds, 3 to 5 to 7 to 10 years or even longer, and rates do normalize, and they do so by the long end of the curve going up, that's going to pose the potential for capital loss to the bondholders that hold those long-term bonds. So it's a tough situation. That doesn't mean all hope is lost. So we have been recommending to our clients, since rates turned up, staying short, not taking huge amounts of risk on the duration front because of the nature of this yield curve has been really smart. And you can almost gain insurance by holding types of bonds that adjust as interest rates go higher. So if we do get a surprise and rates go up, there's a way to enjoy current income and protect yourself from a spiking rate environment. and there'll be plenty of time to get into a longer duration bond holding, but we don't think now is the time to do that. So there are a handful of very interesting ETFs with short-term paper that have pretty stable asset values, not as stable as a money market fund, but close, with a really nice yield premium over those things. And we're introducing those to clients who need income, that don't want to take the risk of getting beat up by being in long duration bonds. So right now is an interesting time. There'll be a time to have more normal aggregate bond exposure, but we just don't feel like now is the time. If you have an interest in learning more detail about our take on the yield curve and how investors should be positioned, our advisors would be happy to have that conversation. There is a way to materially improve the yield on a portfolio over money market rates, and at the same time not expose yourself to the threat of rising rates or the threat of a normalizing term structure of interest rates. So if that sounds interesting to you, give one of our advisors a call and we can have those discussions. There's plenty of opportunity to do really good things in a fixed income portfolio to complement your stock holdings. Thanks a lot. We'll catch you next time.